Cool. All right, we'll get underway. So, welcome everyone who's come today. So, we appreciate you taking some time out of your busy days to come and learn a little bit about healthy write-off conversations. So, there are a few new people that have registered for this webinar, so who may have not known us in the past. So, very quickly, so Ruben and I were the co-founders of Link. So, Link is a capacity-driven workflow system that we've built for Xero Practice Manager. So, how that differs from traditional workflow systems is it has capacity built into it. So a traditional workflow system, you can see what you need to do, but there's no indication to whether the workload you've given your team is even possible. The problems that creates is you end up overloading your best team members because work gravitates to your best people. They become overloaded, they become stressed, and eventually they may leave just because of the pressure they're under. So we solve that problem by giving you visibility into your available capacity. And the other one is deadlines. If you've got the right amount of work allocated, you're more likely to hit those deadlines. So these are some of the problems that we really want to solve with the workflow system that we've built. So yeah, capacity and workflow are the two things that we are known for, and also reporting as well. So what we'll be doing today is Ruben is going to take us through a whole lot of conceptual ideas around how to analyze write-offs and how to have good conversations around them. And at the end, I'll take you through how we can do that in practice using our workflow app that we've built. So I'll hand over to Reubs now, and hopefully the audio is good for everybody. I know we have had some issues in the past, so if there are any issues, just let us know. But we'll do what we can do. So yeah, over to Reubs.
Thanks, Will. Cool. Healthy write-off conversations. Most of us are here, either because been told to become here, or we need to be here. And so, yeah, this is the first step in having healthy write-off conversations is recognizing and probably having experienced either delivered or received an unhealthy write-off conversation. What does an unhealthy write-off conversation sound like, Will?
It's generally you're using them as to come down on someone. So we view write-offs as a way to have really positive conversations to learn from them and to train our team. But yeah, any negative or any sort of I don't want to use the term punching down, but any sort of negative conversation would be an unhealthy write-off conversation.
Awesome. Thank you, Will. I put you on the spot there, but yes,
Yeah.
most of us would have either received or delivered some sort of a negative write-off conversation in our careers. And they don't all have to go that way. And it's often the reason why these conversations don't end up happening. Even where we have a write-off problem in our business and it's acknowledged amongst our partners and our managers and even our people, whenever we try to address it or talk about it, we often lack the language or the detail or the confidence or the culture sometimes to actually understand what it is we're talking about. So that's what we're here to do today. Great. Here's our agenda. We're going to talk about why pricing is the number one cause of write-offs, not people. We actually did a whole webinar on that last month, which I'll just reference as we go. How write-offs are calculated and what they're actually telling you. How to identify the difference between a pricing problem, a process problem, and a people problem when we're talking about write-offs. What a healthy write-off conversation sounds like, and when is the best time to have this conversation, and when is the next best time. Before we get into it, though, some kind of to paint a picture of where we're at in the typical sequence of events when people, I guess, come to us. People come to me and they'll say, Ruben, I've got a problem. I want to improve my recoverability on my people, or we're writing off a lot, or I've got a massive WIP balance, or we're just not productive enough, or my job turnaround's rubbish, or I've got no capacity, no one's got any time. These are all problems people come to you with, and often we will start in productivity. And we'll set some KPIs for people and we'll show them that at the time of timesheet. And then all of a sudden, great, more work is getting done. We're actually making more money. Often we grow our capacity for revenue in our firm. And then it takes about a month. People get some pretty easy wins there. And then we kind of shift that problem because more work gets getting done. People's WIP balances start climbing and they say, hey, Ruben, this is great. Now we're getting more work done and we're growing our capacity. But my WIP balance is climbing, and then we focus on that for a bit. We look at job turnaround, how much work we're giving people. We help managers play the WIP game. We do that for 2 to 3 months, and then suddenly we're doing a lot of work and turning that work around in a reasonable length of time, which is nice. But then we shift that problem again into recoverability. People say, hey, Ruben, this is great. Lots of work happening. We're turning it around. Wouldn't it be nice if all that effort actually turned into invoicing? I'd say, yeah, it would, wouldn't it? And then we look at write-offs, which is what we're talking about today. And we work on write-offs for a few months. Then we inevitably get to pricing or budgets. Sorry, people start saying, well, where do these budgets come from? When I get given a job and it's got a target or a budget, that inevitably is how I monitor a write-off before it occurs. Where does it come from? And we go into how that gets set and how we can communicate that with people and how we can help them achieve a job under budget more frequently. And then finally, we end up at pricing, which we ran a webinar on last month. So that's the kind of typical sequence of events, and we're focused on step 3 here. So wherever you might be in that sequence of events, that's the focus of what we're doing today.
And Rubes, on that, do you want to just go back to the previous slide? Those months that you've got listed there in
Mhm.
brackets, do you want to let us know what those mean?
Yeah, I was mainly talking about how long it typically takes. None of these things, not many of these things, you can click your fingers and get an instant result from, and that's one of the reasons why pricing says 12 months. That's actually the longest and slowest thing to fix in a business, in my experience, because it happens over time, often. You can fix recoverability if you have a recoverability issue. Say coming to us today, and 20% of your team, your firm's effort is not being invoiced, you could fix that within 3 months using the methods we're going to cover today. For example, productivity, mate, you can fix that by the end of the week sometimes. It's a pretty easy problem to solve. Same with WIP, but a little bit more to understand, a little bit more to do, but within 2 to 3 months, you can pretty much half your WIP balance. So these are just indicative timeframes for what a transformation might look like. Does that answer your
Yeah.
question?
So just to touch on, yeah, it does. Yeah. And so just to touch on the productivity thing is
Mhm.
working with a firm recently and very surprised to see one of their accountants over the past 12 months was operating at 43% productivity. And it was a bit of a shock. Going, wow, we didn't have the data. Started using Link, saw the data, 43%. Wow, this person should be at 80. And then it's very easy to implement the right tool to then have them on track, and now they'll be looking at sort of 80% productivity. So that's a double of that person's billables, and it's just by creating that visibility there. So as Ruben said, we can fix productivity very quickly. These
Mm.
next ones take a little bit longer, but yeah, just want to provide a real life example for that one.
Awesome. Cool. So before we get into recoverability, let's talk about the WIP equation. I won't belay the point too deeply, but it's pretty essential. It's a very essential foundational knowledge to running and operating in accounting practice, basically. So this is the full WIP equation. There's no half version of this. This is everything you need to know about work in progress. It basically describes how value gets created in a business, in an accounting business, and how it gets transformed into invoicing and what happens with the difference between those two figures. So just left to right, we start a job, a client, a practice, etc. with zero WIP. Time gets added, goes up. Disbursements get added as well sometimes. That increases WIP. Invoices decrease the WIP, and the difference gets washed up or applied. The invoicing gets distributed across the time and disbursements to achieve a write-up and a write-off. And that's the focus of what we're talking about today. The end result is a closing WIP balance, and that's like a bank account balance that goes up and goes down, but ends its life at zero for a job and for a client and for a firm as well. So that's the full WIP equation. Inside our net write-ups, it's write-ups minus write-offs. So we have some jobs we win on and some jobs we don't. It's the net value of that. And inside time, I just thought I'd point out the obvious, and that time is time value. It's the hours that are incurred at the various billable rates for the various people doing that time. So that is the full WIP equation. Why does it matter? Well, inside that equation, there's rules that govern the interrelationships between invoicing and disbursements, basically how value gets converted. And this is described in the WIP ledger. This is what a typical WIP ledger entry might look like. It should look fairly familiar to pretty much everyone here. It'll be like a time or a disbursement type transaction. It'll have a name against it, Jesse. It'll have a client. It'll have some sort of job or engagement. It'll have some deliverable within that job, individual tax return in this example. It'll have a timesheet date, how long that Jesse's been doing it, Jesse's billable rate, and a billable value. So that's a WIP ledger entry. Now we extend that, or it gets extended by the other side of the WIP equation being invoices and write-ups. They modify or update or extend that WIP ledger entry with new information as it becomes available on the event of an invoice or on the event of a write-up or a write-off occurring. We then get an invoice date. We then have an invoice value. We can say, yeah, the billable value is 100, but it only turned into $83.51. We may have a write-off date, which could be the same date, could be a different date, and then we know the difference or the value attributed to that individual timesheet, and we can form a complete left to right equation for an individual timesheet entry or WIP ledger entry that says on the 15th of April, Jesse Jones did half an hour on that client for that job, for that task, at this rate, generated this much value, but it only turned into this much money, and the difference is sitting over here. And why that matters is because you can do a lot with that. And this is basically the bottom of all the reporting that you ever will have in accounting practice. Everything you drill into, whether you're drilling into a write-off or an invoice or a time entry or whatever, it all should look like this, pretty much. This is the bottom of a robust WIP system, regardless of what practice management system you're using. So we can then take this information and add one extra thing, a little bit of maths, a recovered rate, and we talked a lot about that in our last webinar. This is just taking the invoice value and dividing it by the time effectively. And you can do a lot with these recovered rates around pricing, performance, et cetera, et cetera. But I just thought I'd put that out there as well. We say you can't hide from the rate. So that's a common phrase around recovered rates.
You
Because
can't
at the end of the
escape the
day,
rate because it
you can't
rhymes.
escape the rate.
It's got
Yeah,
to
you can't
rhyme,
escape
bro.
the rate. It's just invoice value, but divided by time. Doesn't matter what billable rate you think you have or should have had. It's still just invoice value divided by time, down at the timesheet level and rolled all the way up to the firm level, client level, etc. Which brings me to my next element, is the WIP pyramid. This is another concept we don't share too frequently, but it should be more widely known, is that if you think about that WIP equation we started with, and I showed you what a WIP ledger looks like with transactions associated with it. Um, that happens right at the bottom here. We saw Jesse James, I think it was, down here, and he had an ITR over here and worked on a job, worked on a client, worked on a that client was part of a group, and a series of groups make up a firm. That equation balances at every layer. So the subtotal of all of these things is the same. These are essential WIP concepts, and why it matters around write-offs is because the subtotal of your write-offs on your jobs will equal the subtotal of all the write-offs on your clients, will equal the subtotal of all your write-offs on your client groups and your firm, et cetera, et cetera. So you should be able to drill down and up across the entire WIP equation, no matter what you do. Cool. Um, if anyone's wondering why people and services are squares and not trapezoids, that is because of interim invoicing. That's the short answer. Interim invoicing is invoicing we generate that is not on the invoice date attributed or attributable to people or services yet. It's things like deposits, uh, upfront payments, fixed monthly fees fall in that category as well. Those are interim invoices. So they sit at a job level, but do not yet sit at a people or service level, just in case you were wondering. Cool. Now, there are only three reasons for write-offs. Three, I guess, groups of reasons for write-offs. In order of most likely to least likely, pricing. Pricing is the most common form of reason for write-offs for a lot of reasons. One of them is that the time we know the least about a job or a client is when we price it, typically at the beginning. So especially if we only haven't repriced that client or engagement for 2 or 3 years, that pricing is the most stagnant part of that job. And often, if you attended our pricing webinar last month, you'll know that we can be setting ourselves and our team up for failure there right from before we even start the work if we haven't sussed that pricing out. Item number two, process. Process here describes the how of the delivery, and it could be the sequence of events or the steps we took or the tools we used, but it could also be the complexity involved in that particular year's work for that job and that client or the entities involved. So there's often things we discover between pricing the work and finishing the job. There's new information that can sometimes arise, which will lead to a write-off if not addressed. Lastly, the least likely cause of a write-off is people. And if you do the maths on that, you think about your average human does something like 1,700 hours of human effort a year. So 37 and a half hour week at 45 or 46 working weeks of the year. If you're 85% productive or 80% productive, you're talking like 1,500 hours of accounting services per year. So if you've been in accounting for more than 4 years, that's 6,000 hours. 10,000 hours is mastery of any task. So if you've been in accounting for 8 years, it's probably not a you problem. That's what I'm saying. Basically. So the chance of it being a Sarah problem is quite slim because learning is logarithmic, okay? So you don't need all 8 years to achieve mastery. You're most of the way up the learning curve for most of the things you do day to day within 3 to 4 years. So do the maths. That's the maths. People are probably not the problem most of the time. Cool. Now, I want to dispel some write-off myths among our team, and this is not for me to share with you, it's for you to share with your team. Couldn't shout these loud enough. If there was only one thing you remembered from today's webinar, it's this one. The number one cause of write-offs is pricing. And when you share that with your team, um, you'll either get a or a oh sort of sound, like a sense of relief and surprise, typically because your most accountants They go to university, you go to university, then you work at a big company, and then you go to another company, and you end up where you are now. No one ever explains to you what WIP is or what a write-off is explicitly so much. They don't really describe how it's calculated, how that number gets distributed to you, why it matters. You just know that write-offs are bad. That's about all you know about write-offs. Write-offs are bad. That's what you think. And you don't want them associated with you. You know that as well. But you don't really know how they become associated with you or how the value is created or what you can do to avoid it. That's most people's level of understanding when it comes to write-offs. And so if we can alleviate or correct the myth that write-offs are an individual reflection of a person's skill and experience, that goes a long way to starting a healthy write-off conversation. Because what we're trying to arrive at is this a pricing issue, basically. So that is the number. If you could share one thing with your team, start there. Cool. Write-offs are not bad. I know I just said write-offs are bad. That is the perception. Write-offs are not bad, and write-ups are not good. There's no good or bad about them. Write-offs are a management accounting tool. That's all they are. They're accounting fiction, basically. I could make all your write-offs go away today if you wanted me to. I would just take all of your billable rates for your team and I'd update them to be their actual recovered rates. And then, amazing, Ruben, you fixed my write-off problem. Am I making more money? No, you're not. In fact, probably making less money because by reducing someone's billable rate from 250 to what they actually recover for you, which might be 200 or 220 or something, every time they do hourly work, it's now at 220, not at 250. So they're probably losing money on the hourly work they do if we were to do that. So write-offs are not good or bad, and the good firms that I deal with that are quite across this stuff, they actually want to aim for um, a low negative number for most of their team is what they want. They don't want people chilling too much. They don't want people with deflated billable rates because that doesn't really help them when it comes to hourly work if they do any consulting or hourly rate work. And it gives people a good target and a good objective when they're delivering work. And they adjust people's billable rates each year to kind of aim for a low negative write-off for that individual. So write-offs are not bad. They're a management accounting tool. That's it. Cool. I've said this slightly earlier, but just share a story around it. Write-offs are infrequently a reflection of an individual's skill and experience. So you could have three partners at an accounting firm go to a accounting conference, and one of them would say, "Oh, we wrote off $500,000 last year," and the other one might say, "Oh, we wrote off 15%," and another one might say, "Oh, we wrote up 5%." No useful information was exchanged in that conversation because we've all got different billable rates, we've all got different businesses. The write-off value by itself, or whether it's a percentage or a dollar, means very, very little. It's certainly not a reflection of someone's skill and experience. And where I often run into this issue is actually around when people are promoted into a management role or like a manager type role out of it, like a senior kind of accountant role. They're used to, as a senior accountant, being individually responsible for their revenue generation, basically. And we put them in a position where they are in charge of others and they're meant to be leveraging their knowledge and experience onto others. And what often happens is that if you've ever moved into like a senior accountant, into like a manager of others sort of role, is your write-offs will go up. You'll have more write-offs because you're more likely to be involved in uglier work. You're helping people, you're training people, you're doing client work, but it's not you generating the revenue. And sometimes people can get quite upset about that. They feel, because we've trained them to feel throughout their careers that a write-off is a personal failure. So we try to educate those new managers saying that, hey, write-off is not, because what they do is they're like, oh, Ruben, I don't want to have a write-off against my name. Just give it to my team. They can have the write-off. I'm doing a great job over here. I'm like, I know you are, James. I know you are, but that's not your job anymore. Okay? We're not measuring your success anymore, Mary the manager, by your ability to individually generate revenue. So the fact that you got write-offs against your name is not bad or good. That's not your job anymore, basically. So, yeah, that's a kind of a mindset shift that we sometimes see or don't see. Cool. Write-offs are not symmetrical. They're asymmetrical. You are much more likely to have a write-off than you are a write-up. It's not a yin and yang thing. Things have a way of going wildly wrong before they have a way of going wildly right. So do not be surprised when you see when write-offs are the norm and write-ups are smaller than the equivalent write-off. You're much more likely to see a write-off than a write-up. And lastly, just more of a language thing. Sometimes people will say that write-offs are losses or write-ups are profits. That's not strictly true. We're talking about the WIP equation here, which uses billable rates, not cost rates. Um, Profits and losses, like you'd normally hear someone say around a job, oh, we made a loss on that job, and they're talking about a write-off on that job, or we made a profit on that job, and they're talking about a write-up on that job. But that's not true. So we want to try to use correct language when we're talking about these things. These are different measures that we can use for different purposes. Write-ups and write-offs are not losses or profits. Yep. Um, I had one other point around that. I had a question last webinar, actually. Ruben, we were talking about pricing. Ruben, can I use margins or profits as a measure of, identifying clients that need repricing? And I said, yes, you can. It's, the same. It's not that different to write on a write-off just at the cost rate instead of a billable rate. But if you think about your billable rates that we're using, for our WIP equation, they're 4 times larger than the direct cost of the person doing that work typically. So if you're looking at a list of clients, your write-ups and write-offs alert you 4 times more frequently to problems in delivery, pricing, process, etc., than a profit margin would. So that's where profits and write-offs do relate. Cool. All right. This is the last slide before we get into some actual examples. I'm actually kind of going ahead here. I'd normally do this with the data itself, but I thought you guys might want to maybe screenshot this or save it. But this is what I would describe the start of a healthy write-off conversation like. An unhealthy write-off conversation goes like this. Hey, James, you wrote off $2,800 last month. Sharpen up. That ain't helpful, Ruben. I don't even know what that means. I know it's bad, and I know I don't want to have this conversation with you again, but I have no idea what to do differently from here. And unfortunately, for a lot of the reporting people receive and a lot of the experiences people have had in the past in their careers, that is the extent of what a write-off conversation has sounded like. Managers don't like having them. People don't like receiving them. People just kind of go through the motions and wonder why nothing changes. And so that's what we're trying to do different. This is what a good write-off conversation or a healthy write-off conversation might sound like. And you notice they're all open-ended questions. They're inquisitive questions. There's no, they're not witch hunty. We're trying to get to the root cause of the issue, or try to encourage the person most likely to know, the doer, to let us know something we can take to a pricing conversation later in the year, basically. I want to note that down so we can actually use that as a cause for a price increase, pretty much. I'll talk about that at the end. But was there anything unusual about this job? Hey, James, was there anything unusual about this job? Client job number. And you want to do this in a kind of timely fashion, monthly at the end of that job, or when the write-off occurs. Was there anything unusual about this job? And sometimes that can be enough for someone to come up with some suggestions. Yes, there were some more entities. The director's loan account was an utter disaster. The quality of the data was shocking. There was a massive volume of transactions, lots of fixed assets this year, or lots of disposals, et cetera, et cetera, et cetera. These are all like golden nuggets that you can then take to a pricing conversation later. And that's what you want as a manager and as a business owner. Was this job more complex than anticipated? Another open-ended question. Should we be charging more for this work? Now, that's a forward-looking question. We're not talking about the past. We're talking about the future, something I can still do something about. Do you think, James, that we as a business should be charging this client more? Now, that's an awesome question to ask an individual, because they ought to have an opinion on that. Should we have charged separately for some of this work? Now, it's a retrospective question. So of the work we did, do you think there's any of that we could have, with the benefit of hindsight, bundled up and charged separately for? And that's often the case for things like scope creep that we haven't identified, that we could be bundling into next year's engagement, or could be pricing into next year's engagement, or identifying on next year's job when it occurs, and helping people kind of join those two dots together. Oh, sorry. Is this likely to take 12 hours again next year? Here we're relying on people's skill and experience to say, you've just done the work, it took 12 hours. Do you think it could be any quicker next year? And they go, yeah, it was the first year I did it. Next year it's probably going to be 10 or less. Awesome. That's good information for me to know. It means I'm less likely to need to reprice that engagement. Or yeah, it's probably going to be 12. Yeah, we needed to be charging more for this client. Could we have delivered this any differently? This is more of like an innovation process, technology type question, perhaps. With everything you know, James, about delivering this job, is there any quicker way do you think we could do this? Awesome. Great. Using the creative brain in James. These are all wildly better than James Sharpen Up. So cool. This is a screenshot that, put it on your desktop. I don't know what you need to do with it, but these just examples. It's not an exhaustive list. But this is what we want our people to sound like. And all I say is one good conversation per person per month. That's it. So it's just one job per person per month. That's like plenty. You'll be surprised how effective that is. And we'll look at some examples right now of that. Um, cool. Any questions, Will, while I go on?
No, just no, someone just wanting the access to these slides because you've done a great job putting them together. I'm
All
sitting here enjoying this whole thing as well, man. It's the first time I've heard most of this content. Oh, we've talked about it, but first time I've seen you put it all together like this. It's awesome, man. I'm enjoying it.
All right, rock on.
Keep doing your thing,
Cool.
man.
Cool. So yeah, the slides will be available. They'll be available in the same place as the watch later. So don't worry about that. Cool. So this is in-link reporting, but whatever you're using for your write-off conversations, use that. This is just an example. This is a team performance report. This is how we'd often have this sort of conversation. I'll run this for, I'll just run it for the last 12 months. But typically we do this month to month. So one good conversation per person per month. And we're going to have it grouped up. You don't need it to, depending on the size of your business, you may have a team that you're responsible for, or you may be responsible for everybody. But you want to make sure there's one clear person having this conversation. Don't leave it up to guesswork. Don't just trust that one of your managers is going to do it, or know who's going to do it, because given the opportunity, people will avoid it. So we want to make sure that everyone knows that Sarah, your job is to have one good conversation per person per month for those three people. Here's how you do it. Don't leave it to two. We say the dog with two owners dies. So don't leave it to two Sarahs. Don't leave it to no Sarahs. One Sarah to do this job. So inside this, whether you're going to group it up by team or role or filter or something like this, we want to be looking at our people. Here's all of our people, and I'll just explain this left to right. We've got the time they've put in, productivity, the value they've generated, and here's the column we're after, net write-ups. So this is net write-ups for Bianca for that period. And inside that number, that's where all the gold is. So we'll look at that in a moment. Continuing, that's a write-up percentage. It's the percentage of write-offs as a portion of all the effort she generated in that period. That was her revenue, so what actually turned into money. Cost is not in here, but could be. Gives us a profit and ROI and average hourly rate, which we talked to in other events. But what we really want to do is this write-up column. So if you sort, this is kind of where you want to go. And we want to start at the top and work our way down, basically. I'll just pick on Greg because he seems to have quite a lot. We're saying, hey, Greg. Actually, I'll pick on someone who's maybe a bit more productive. So Curtis here. Curtis here in the last 12 month, say, June, spent 72% of his time on clients. And is that good or is that bad? Well, we'd reference that to a KPI of some sort. That's not the main purpose of this conversation. But with that time, generated 100, that's a very big number, but it'll be $20,000, $30,000 worth of value. But we were unable to invoice $16,000 worth of that. And this is the number we want and the drill down we want. So we drill into this and we're looking for one good conversation per person per month. And this is basically that WIP transaction. That WIP transaction we talked about at the beginning, but from left to right, these are all the little micro adjustments to someone's timesheet, basically. If you scroll on down, there's going to be a lot of them. I should have maybe picked a smaller period, but we will scroll on down. We're looking for one big number. So here's a year's worth of write-offs. That's a big number. This is going to be my one conversation with Greg this month. And it's going to be about Steely Limited, some general tasks, mainly secretarial services we did. We were unable to invoice $1,100 worth of his time. Now, my question would be, why? And I could read all the narrations. I'm sure he writes great narrations in his timesheets, but it'd be a lot quicker for me just to go and ask Greg in person, ideally, or on a Zoom call or on a phone call. I don't think email or chat is a helpful way to have this sort of conversation personally. You're much more likely to get a more real answer if you're speaking, I believe. But we want to ask those great questions I had earlier. These ones here. Hey, Greg, was there anything unusual about this job? Yeah, it was general tasks. Oh, okay. Well, what were they in relation to? Oh, they had some issues with their company's office registration, and I had to end up spending 5 hours solving it for them. Oh, wow. Okay. Do you think that's likely to recur next year? No, it was a pretty one-off task. Do you do you think we should be charging separately for some of that? Oh, I probably could have, but I didn't raise it with them, and now I'll just need to. Now there was a write-off. Okay, cool. And then now we're getting to the root cause of what we can do differently and how we can avoid having the same value incurred next year. And we're planting the seed in Greg's head that, well, Curtis's head in this example, that this is not a witch hunting scenario. This is not a reflection of your individual ability to deliver work. It is more around what can we do differently so we're not staring at the same write-off for the same client on the same job this time next year, which is what tends to happen. So that is one example we could go into. And you're going to, that's the kind of detail you would need. You want to see kind of like, yeah, the client, the job, the part of the job that didn't go to plan, the value, so you know what your one job's going to be. You don't really need to read the narrations, but you just want to have an open-ended starting point like this. Cool. So I'll choose another example now. One more example. I'll show you. I'll see if I've got any big write-ups. This is sometimes you might see this, especially if you run it over a longer period. You have people who have massive write-ups. Um, that could indicate that their billable rate is too low, and they would benefit from an increase in their billable rate. As I was saying earlier, a lot of firms target a low negative number. So although a large negative is like not, that's a talking point, I suppose. Large positives can indicate that people are cruising at they're actually better than their billable rate reflects. But to know if that's the case or not, you need to drill into that figure as well. Cool. I'll just drill into one more figure here. Who did I do? Curtis. We'll try Derek. Cool. Whole bunch of little rats and mice, write-ups and write-offs and things like this. Cool. And I'm looking for one big number. Normally it's one job. It's amazing how one job can just delete a whole bunch of jobs that went to plan or actually went okay. One job like this can really ruin someone's month. Peter's pork exports, GST return. It took a lot longer than expected. Um, hey, Derek, uh, do you think it's going to take 12 hours to do this GST return next year? Yeah, probably because of ABC, volume of transactions, number of entities, et cetera, et cetera. Cool. We can price that better. Um, could we have done this GST any better, differently? These are all good ways we could start that conversation. So that's an example of what I'm talking about with healthy write-off conversations. Let me just bring back my agenda here. Any questions on that, Will, before I move on?
Yeah, actually, there was one really good question.
Hmm.
From it's around XBM wash-ups. So,
Yep.
question was around, are we how do we deal with the apportion? So there's apportionment method, and then there's explicit write-off
Yep.
allocations. And the question was around what's the best approach? Do you want to answer that, or do you want me to answer that?
Yeah, great question. What is the best approach? Man, I am more of if we're having healthy write-off conversations and we acknowledge that write-offs are a pricing issue mainly, and that they are a management accounting tool for making decisions and acting on them, then I'm more of an apportionment method guy. I think don't get in the weeds around distributing write-ons and write-offs among people to tasks and times if you can avoid it. Um, yeah, take a bigger
Great.
picture. Take a bigger
That's what I
picture
said in my
on the
response.
entire firm and change the culture around it completely so that we're not fighting over who's wearing this and who's not. Yeah.
Yeah, so generally what we want to do is when we're doing our wash ups, you just want to use the remove from invoice list,
Yep.
which creates the wash up, and it just takes all the interim invoices
Hmm.
and all the time, and it just apportions it across all of those billable entries, and you get this nice
Hmm.
apportionment of those write-ons and write-offs. So
Hmm.
someone may have done, let's say there's a $6,000 on a job. I didn't make my numbers easier. $5,000 put to a job. One person did 1,000, the other person did 4,000. Well, we're going to
Hmm.
have 20% of the write-off apportioned to the one who did a grand, and we'll have 80% apportioned to the person who did the 4 grand. So it's just nicely apportioned out based on those billable values. So a much better way of doing things rather than having someone going through and picking and choosing. Otherwise, you're going to end up having,
Hmm.
yeah, you can imagine the problems that come with explicitly choosing, because it'd be like preferential treatment of some people, and yeah, cool. Hopefully
Cool.
that answers the question.
So we looked at an example with a team, and that's probably the kind of the easiest place to start. But not everyone's got the sort of the drill down detail that I've shown you here. Another method you might consider would be a job-based approach. Same principle applies. One good conversation per person per month. And I'll show you just an example what that might look like. I'll just run this for like the last 12 months. Show me everything show me every job that got finished last month. Cool. This is information most of us would have. Sort by write-up. Cool. Good start. Great. And I'm looking at the dollars, not the percentages. I find dollars like much more tangible. It means I'm focusing on areas that can make me more money. I'll just pick on like cry no more. So here's a job, directors meetings. Man, it's probably not a great example, but we'll just go with it. 91 hours went into it, 15 grand worth of value. We only invoiced 12. We wrote off 3.3, 21%. That's quite a bit. Profit margin, etc. Recovered $134 per hour on that. If you drill into that a bit further, you'll find a whole bunch of tasks and people. And if you drilled into any of this a bit further, this has only got one example. I should see if I can find another example. This one here, this is more typical. You can see where the time has gone. And when you look at the part of the job that didn't go well, it's normally the annual accounts. When you drill into the bottom of that, you get that full whip transaction is what you need. So you can go, oh, well, there's a few people who got their share of the write-off. This is actually answering or talking to that apportionment question you just had. The job had a write-off here of 12 grand or 2 grand or whatever it was, but you can see how it's been distributed by the various people who worked on it, by the weighted average value of the billable effort that went into it is the kind of the default method in XPM. So it's mainly Jack who did this work. Jack's manager also got a share of the write-off, and so did Fiona, who also helped out, but Jack is the guy to know. He's the best person to know the most about what didn't go well here. And then sometimes when you're looking at it at the job level, you want to know, well, is Jack quite junior? Is this quite normal for Jack? Is that normally how long it takes him? Is he any good at it? Is he pretty switched on or not really? And that's where you would kind of use a bit of both, like your knowledge of Jack, your knowledge of the client, and your knowledge of the reasons for the write-offs to form an opinion as to is this a pricing problem, a process problem, or a people problem? But we're relying on our people to give us those golden nuggets. It's so much easier if you're on last month's webinar around the pricing to walk into a pricing conversation with causation. You want to you need a because word in your pricing conversation, your repricing conversation. You need to say, hey, ABC Limited, or hey, Mr. Adam, your pricing needs to be this because of reason James gave me, reason Sarah gave me, reason Ruben gave me. Brilliant. That's brilliant. So much better than it just appearing random. Yeah. So pull those nuggets out of your people. Cool. So that's pricing process or people. Now I'll hand over. That is healthy write-off conversations, what they sound like retrospectively. And if you're not doing anything else, that's the best place to start. Super easy to talk about the past, especially if it's in the near past. Something you could do probably today or this week. But inevitably, people start wanting to have those conversations, but ahead of time, because we're closing the gate after the horse is bolted, having great conversations after the job's already not gone well. We want to start having those conversations, the same questions, but while the job is still in progress. And that's where budgets come in. So I'll hand over to Will to show you what we do with budgets and how we can have the same conversation, but week to week. One good conversation per person per week instead of good conversation per person per month. So yeah, leave that with you, Will.
Yeah, sweet. All right. So I'll share my screen here. Can you let me know if you see that? You got my screen, Reubs? Can't hear.
No, try again. Hold on.
Try again. Yeah.
Yes.
Should be good. Should be good now. Okay, perfect. Awesome. So the product Ruben just showed you was our reporting product, which is currently, as many of you know, under a rebuild into the new platform. This is the new platform. This is our workflow capacity system. So what we're looking at right now is my workflow. And this is the list I look at every day when I come to work to see what tasks I have on. And you can see this is my list for July. And I can see all my work ahead. So there's my August list. I can see my September list all the way through for the year. So everything I've been allocated. Now, you can see I've got 16 hours of available capacity. Now that stays live with every timesheet, every interaction I have, every task that moves, every completion of a task that stays live. If I want to know how that's made up, I can click on this value and it opens up a new tab for me with how that calculation is made up. So it's made up from my expected hours, how much leave I've taken, and my target capacity. So I get a target billable and an available internal, all the way through to how much I've actually done, giving me remaining internal, what I've been allocated, and my availability, which is, as you can see there. Cool. All right. So this is my workflow. Now, each team member is going to have their own workflow list that they work from. But what we want to do is we want to use practice workflow, which is another view here, which allows us to see across all of our team members. So as you can see, this is my whole year ahead. When I go to practice workflow, I'm actually looking at my entire team for July, and I can always jump forward and look at different periods. But genuinely, we're trying to make decisions right now with what's happening right now. So what I want to do is do a workflow meeting, and you go through each of your team members, and you can just catch up on where they are with their workflow. So let's say I click on to Josh, and I can see his list here, and this is all prioritizable. So I can send this to the bottom, and say, hey, Josh, I had a call from Matt's Merch. They really need this work done. So I can drag this to the top of his list, and then I can flag it to info collection. So he needs to get started on that right now. Now, go to Caitlin here. I can see Caitlin's list. I'm looking for someone who's overdue. Here we go. So for Raymond, we can see here, when we're talking about healthy write-off conversations, I want to talk to Raymond about jobs that are overdue. So he's got 3 jobs on his list right now. They're all overdue, and I can see that because the due date's red, and it's due back in May. And this job here, if I put this to the top of the list, you can see that it's allocated 10 hours, and the actual time's 19 and 6 minutes. So he's 9 hours, 6 minutes over. So this is something that we could have jumped on earlier. So imagine earlier last week, he put no time to it, have the meeting this week, and it's got 9 hours over. And, this might be in, let's say, work papers, for example. I can have a chat to him and say, hey, what can we do now? You're almost double the budget on this job. And one of those healthy write-off conversations that Ruben ran you through earlier, you could say, is there anything we could do just different here? Do we need to reprice this? So you can look at charging for variations or jumping onto these potential write-offs before they blow out. This is quite a bad example, 9 hours over, but ideally we're catching these things sooner. But then we want to go through and essentially have these conversations in our weekly workflow meeting. So then I come down to my list here, and hang on, sorry, this one here. There's my list here that we saw earlier. And then I can see that this task here, 10 hours allocated, 13 hours done, and I'm 3 hours 38 over. So what we can do as well is in Link we have customizable statuses. So as we move our work through each phase, we can move it through, sorry, what I'm trying to say is we have customizable task states. So you can customize those stages based on the type of work you're doing. So for example, annual accounts will have these stages. Now I can look at this in context of where it's at. So I'm 3 hours over budget right now, and I'm still sitting on work papers. It still needs to go through a review. I still need to prepare the draft. So I can see that there's quite a bad write-off coming potentially. So it allows you to jump on these conversations way earlier rather than looking at what Ruben showed you earlier, which is the retrospective reporting. That's what has happened based on our WIP. There's a good way to get on top of those. So just show you a couple of cool things here is when I'll go back to my workflow. So when I complete this task, it'll complete its in at the bottom of my list. Now, because I was 3 hours over allocated, over budget on that task, it doesn't change my available capacity. But let's say this task here, I've got 40 hours remaining on it. If I was to complete this, what it does, it's going to credit my capacity. So check this out. So I got 16 hours, complete this one, goes to 56. And that's what I mean about keeping capacity live at all times. Last thing I'll show you here is our work chat. So I'm showing a little bit of the things that we've got here, but we've just released work chat, which allows us to have conversations with our team about the work. So starting this job now, and everyone that's working on this job will get this notification. And I can send a GIF through like this. Try to find a good GIF here. There we go, like that. Now Ruben's going to get notified because I can see that he's also working on this job. So if I can come out of here, if Ruben was to respond to that, I'm going to get a little notification and let me know that that's that he knows that I've started the work. Just waiting for him to do that.
I sent you a different one.
Oh, on a different job. That's cool. That's sweet. So where this is really relevant is where we work through these stages here. When the job goes to in review, I can then jump in here and I can send a chat and I can say, ready for review. Ruben can get that notification. And then you can move it through those stages as well. So these statuses keep consistent across everyone. So if we've got multiple people working on a task, those stages stay consistent. So then Ruben can move it from review back into review notes, and I can pick it up and keep it moving. So we call it passing the baton. So it makes it really easy to pass the baton. But just looping back to what we were saying earlier about these remaining times, a really good way to stop write-offs before they occur is in these weekly workflow meetings. Run through everyone's list, make sure it's all everyone's keeping under the remaining budget, and have those conversations early on before they end up blowing out. Now, how do we get these in the first place? How do we arrive at our allocations? So we do that by coming into here and allocate work, because we're looking at workflow, but how do we get our work on workflow? We do it here and allocate work. So when we go and allocate these jobs, I'm just going to choose, so I can search. Let's say I'm going, 75 limited. So if I go 75 limited, it brings up this client for me, and I can come through and say I'm going to allocate this task to Will, 10 hours, and we want to make sure this is in line with the job's budget. So I can put a due date in here. I can also add Ruben to it. So Ruben's going to do the review like this, 2 hours for the review. And then these are the budgets. These are ideally aligned to our financial budgets there. And then what it means is that when our hours exceed 10, we know from a financial perspective, we're going to be exceeding that financial budget as well. So I can publish this, and you'll see 75 limited will be put on my workflow list over here. So if I type 75 limited, it's going to search my list. And there it is sitting there in my July list. So what I can do is I can move this over to info collection. And then I can push this to the top of my list. Now, so you've got a notification on this one here that Ruben's just sent me that notification. So let's see what he sent me. There we go. So he knows the job's underway now. So that's how we allocate our work. Now, how do we come up with those numbers? So how do we know that was 10 hours? So what we want to do is we want to be referencing our budget. And a really good place to start is what we did last year. So we've got this really neat feature in here. If I go select, let's say all of these jobs here, and then I go view suggestions, that one's got no historical. Try to find some with some historical data. I think these guys do. Cool. Go view suggestions. It pulls through the historic data from previous jobs. So it's gone through and found 10,000 feet limited. The last time we worked on annual accounts preparation, these are the people that worked on it. This is the time that they worked on it. And we can jump between using the estimate from last year, being these previous estimates, or we can do the previous actuals just like this. Like that. And as we're allocating, we get a preview of how much capacity each team member has. And that means we're not going to over allocate our team once that work's been allocated. So if you've been using XPM for more than a year, we can basically pull through all of those, all the work that you did last year that can drive your allocations for the year ahead. And then ideally, we want to be checking those against our budgets to make sure that we've got those accurate to reconcile with what our financial budgets are. And then we're managing, doing a weekly management meeting to make sure that our team are on top of our remaining times to make sure that we're going over budget. So that's it, really. That's how we'd manage budgets on an ongoing basis, or keeping sort of live management of your write-offs.
Excellent. All right. I'll
pass back to you, Reubs.
Thank you. Oh, some closing points here. Can you see my screen?
Yep, got it.
Great. Remaining budgets. That is the easiest win. Yeah. Get a budget on every deliverable, and the easiest budget to start with is how long that thing took to do last year. So at least when it turns red, you know, well, it's at least harder than it was to do last year. So that's a good start for a conversation. Yeah. Cool. And you can, yeah, our customers find you can do that for 80 to 90% of your clients. It's only brand new clients that wouldn't have much of a history yet to draw on or pre-populate for you. All right, that's automated budget allocation that Will covered. This is basically what we're doing here at Link. Do you want to talk to this bit, Will?
Yeah. So I'll just paint a picture of where Link is heading in terms of our development. Is we see where the industry needs to head is this idea of connected practice management, where the data from one part of the process feeds the next. So where we're at right now is the proposals and the job creation is done in XPM, which is the top there. So that's something we're really going to be focusing on the next part of this year. But once the job's created, we do the allocation and Link, which you've seen. You can do that job by job, as I did at the start, or we can do that in bulk using last year's history. That allocation feeds your capacity. Your capacity informs your workflow, so you're making good workflow decisions around who we're allocating work to, who's over allocated, what needs to move. And then the workflow will drive your invoicing. So the invoicing is a part that we haven't built either. And then the reporting. So your invoicing, that WIP ledger drives your reporting. And the reporting should inform your proposal, so that those re-engagements for future years, because we're going to have that write-off information available for that re-engagement. So where we're working towards as a company is connecting all these dots here. Now, at the moment, invoicing and proposals are two things that are done by XPM, but we're really focusing on building all 6 parts of this wheel. We'll always work with XPM, so XPM can always sit in the middle, and we'll be able to send and receive data from XPM. So if we want to keep XPM as the hub, you know, the single client record would sit in the middle. But in terms of your workflow from proposal through to your workflow, your invoicing, and back to the proposal again, we're trying to own that whole piece and make sure you don't have to use 100 different apps to try achieve this. And because we're handing data from one part to the next, it means that it's intelligent. It learns from what's happened in its previous cycle as well. So just to give you a heads up where we're heading in terms of our product. And it'll work standalone from XPM, or it will work with XPM. You get to decide whether you want the integration on or not, but you'll have the same experience whether it's connected or not. Yeah, so this is just where we're heading as an app. Cool.
That concludes Healthy Write-Off Conversations. I hope we all can go away from here and have some healthier conversations. It does take time, especially if you've had a history of not unhealthy conversations. It takes a while, or a month or two, as we saw at the start, for people to start to be more forthcoming and start to let their guard down around why you're actually asking these questions, which is mainly a pricing, something to take to a pricing meeting.